I'm very excited to be moderating this panel. I would like to first introduce our speakers, a really diverse group of industry professionals with experiences across mining, ESG climate data products, and fund management. So we have Roberta, partner and chief growth of Hashdex, and then Bill Kentrup, co-founder and head of Origination from Allinfra. And lastly, Brian Mosoff, CEO of Kentrup Capital. So when discussing ESG and crypto assets, the first thing that people focus on is the amount of energy Bitcoin mining. So energy consumption is essentially equivalent to carbon emissions. But before we start looking at the energy aspect, maybe we should start framing the question from the social and governance aspects of ESG. So, Brian, how would you look at the energy, reframe the energy consumption issue, given the social utility and governance aspects of digital assets?
So, I think it's important to remember that ESG is a three-letter acronym. Most people are very focused on the energy consumption, which I'll speak to in a moment. But it also, in terms of social and governance, these open networks, blockchain, Ethereum, competitors to those platforms, are global platforms that are very inclusive. The code is open by default. It's published on websites like GitHub, where anyone is able to read that code, contribute proposals. And so in terms of the creation of money or monetary policy, these are the most inclusive and global systems that we've ever seen. And that is really something that I think a lot of people miss. People are very focused on the E part, but they don't think about how open these things are, how much they are going to contribute to decentralized finance, global inclusion in a new financial system. And that is something that is really fantastic. In terms of the energy consumption, I'm going to let Ben, when he comes, give some more drilled down numbers. But I think it's important for people to recognize two things. And the first is that in Bitcoin mining, there is an incentive for people to co-locate their activities next to services, businesses, other activities that give off energy as a byproduct. And that even though it may, in the early days, not have started off as clean as it is today, over time, as people are just arbing that spread, basically, in the electricity cost, you will see people move towards greener sources, places where they can get cheaper or basically free electricity. And we've already seen that happen on the network. And I think that that's something that's very important to keep in mind. You saw El Salvador announce recently that they mined their first Bitcoin by co-locating next to a volcano. Really, really neat innovation that we're seeing. And then the second thing I want to point out is that new networks like Ethereum and other smart contract platforms are transitioning away from proof of work mining into something called proof of stake. It's something that I'm personally very in favor of. I'm very excited about proof of stake. And what happens in proof of stake is it removes this commodity from being external to the network, right? And in proof of work mining, it's computing hardware and electricity. And now instead, the native token to the network gets locked up in essentially a bond with the protocol. And that's what people are putting at risk. So it's not electricity and computing hardware. Now it can be the native token of the network. And I think you're going to see this rotation of capital in the upcoming years from people who might look at proof of stake as, maybe more aligned with their investing models and things that they want to have in their portfolio, and as a way to participate in these forms of decentralized governance and really democratize the access to validation on these networks. So that's something that I think is really important to keep in mind and really exciting, something that's happening in the space right now.
Thanks for sharing that insight. So Roberta, I'm also really keen to hear your perspective from the Latin America context, especially where the continent has seen the use of crypto to beat hyperinflation.
Yeah, sure. I think Latin America has been pretty busy recently about the crypto space, right? I think one of highlights of the year has been El Salvador becoming the first country in the world to accept Bitcoin as a legal tender. And although it's a very small country, I think this is a very relevant statement and an important an important ecosystem. And it's powerful to see that the idea that 70% of the Salvadorians, they don't have even access to traditional financial market services. So these are one of like the social benefits, I believe, as like Brian was mentioned about the coin. Also, like we can talk a lot about like the importance of crypto in countries like Venezuela, that has like been suffering like 3,000% in inflation, I think last year, and it's something around 500 this year alone. In Argentina as well. I'm actually in Brazil. We are in a different scale, but also suffering from probably an inflation of 8% this year. And I think what I've seen in Brazil so far that has been like really interesting in the space, and I think like the biggest innovation has been around the development of products that offer crypto in the regulated space, right? So Hashdex has been a leader in Brazil recently, and we launched it like the first world crypto index ETF, and right in March this year. And right now we already have like 3 ETFs. One is Bitcoin only, and the other one is Ethereum only. And I think it's interesting to see that like Hash 11, that was like our first ETF, is already like the second most traded ETF in the Brazilian stock exchange. So I think it shows a huge achievement, and how like the region has been kind of open to adapt to this new currencies.
Thanks. I think Phil, given Ben hasn't joined yet, I'm also interested in your view, especially you're an energy professional. How do you see the energy consumption debate in the crypto space? I mean, especially taking into account the leakage or curtailed the use of curtailed energy.
Yeah, it's an interesting topic. It's certainly one that emotions can run high when people debate the topic. So I think we'll not try to step on any landmines here, but for sure, I've been financing renewable energy assets for the better part of 20 years. I've been in climate finance for about 15 years, and one of the challenges in the renewable energy space is, renewables produce power at a certain time of the day. For solar, it's midday. For wind, it's when it's windy. And, power storage is getting better and more efficient. So over time, you can produce a lot of power and store it. But many circumstances, you've got excess energy that you can't use at that particular time. You don't have the transmission to move it where you need it. So it's basically wasted energy. And, in some very large renewable markets, you have, upwards of 10%, sometimes 20% of the largest renewable power production in the world that has curtailed power, meaning power that you could produce, but you can't dispatch and sell. So I think that, amongst a number of ways to utilize that excess power, converting that excess power into value in the form of a kind of the ESG side impact of crypto is very significant. And if you're converting excess environmental energy into social impact, that's a great way to store value and transfer value. So I think, I'm starting to see some pretty interesting innovations co-locating renewable production with mining. So I think that's definitely helping the environmental footprint of the proof of work space in general. And then, as Brian mentioned, transition into proof of stake. And, probably it's not a one size fits all. So I see room for proof of work, really improving environmental impact in certain circumstances. But that said, there is the negative side of it. So I think that, there are circumstances where potential power that, in areas where there are power shortages is being used for mining as well. So there's definitely some negative impacts in places.
Okay, thanks for that.
Sure.
So let's move on to look at product innovation using DLT and blockchain in the ESG and green product space. So Phil, so you have been involved in the use of blockchain, digital assets to accelerate ESG-aligned finance. Can you tell us what the advantages of blockchain and tokenization are, and share some of the use cases?
Yeah, sure. So for us, there's two main areas that we use blockchain in environmental finance. One is on the data side, so collecting and storing ESG related data from assets, and the other is creation of tradable digital assets that carry with it the commercial benefit of an environmental financing as well as the environmental claims. And that's, both of those things, whether it's digital or not digital, need to happen for environmental finance to progress. Our goal in using blockchain is really to bring about efficiency, certainty, and reduce cost into that environmental finance space, and also to create optionality, which in turn drives environmental finance. So just quickly to calibrate on the market opportunity, you've got 197 countries that have signed on with commitments under Paris agreements. You've got a wide range of national, regional, decarbonization targets being set. And then you've got corporates, asset managers, and financial institutions also setting significant low carbon and as well as broader ESG financing targets. That sets the backdrop for trillions of financing that needs both transfer of that commercial benefit, but also verification of the environmental impact. So on the data side, that data is used for things like green ratings, accounting for equity debt and bond financing, as well as for things like carbon credits and renewable certificates. And here's where blockchain comes into play there on the data side. So historically, as I mentioned, I set up one of Asia's first climate finance platforms back in 2004. And up to now, the process for getting that data into a financial product has been very manual. It's highly unpredictable. It's very costly. And taking data from assets, putting it into a digital environment allows for a significantly reduced cost and time related to converting that to product. And it allows, it really creates optionality, because when you have data that creates a product that's accessible and you can use it for multiple use cases, not just one, the ways in which asset developers can convert data to value is much more wide and much more predictable. So the sort of assets that we're talking about here are things like financing renewable energy assets, low carbon infrastructure like transport and logistics, agriculture, forestry, where it comes to carbon reductions, energy efficient assets. They're all very CapEx intensive. They need a ton of financing, but they deliver high quality returns and green benefits. So if you can bring a better high quality product to market, you're accelerating that green financing. And that's, taking now a digital security or digital finance token that represents equity debt or hybrid exposure to the asset, having digitally verified green impact is, it's really changing the market. For some flavor, I guess, we're working on projects where we're verifying the power consumption at energy intensive assets and time and location, matching that with procurement of digitally created renewable certificates. We've got a proof of concept with the Bank of International Settlements where tokenized climate bonds are using blockchain based ESG verification. So the bonds being verified by data collection on blockchain. We have a very large client called UPC. They're one of the highest quality private renewable developers in Asia Pacific. And in that circumstance, creating digitally verified and tokenized carbon credit spot and option contracts. In all these cases, it's more efficient green financing. It's creating greater environmental impact. And I guess the last thing I'll say, and I'm not sure if it's particularly helpful to put it this way, but I'll do it anyway, which is we're not a blockchain enthusiast platform trying to figure out ways to put blockchain into market use cases. We're actually longtime environmental markets team. And it happens to be that blockchain is a great solution for really accelerating this market. So we're using blockchain because it has big impact on the market that we know and love, not because we want blockchain to sort of appear, across markets.
Okay, that's very interesting, and I agree, and I think the use of blockchain definitely can accelerate access to these green products because of its ability to track pigments and all of that. So Roberta, can you maybe tell us a bit more about how Hashdex has created a carbon neutral crypto product? And in particular, what's your approach to calculating carbon footprint, and how do you make sure your calculation methodology is actually meeting your carbon footprint?
Sure. Yeah. First of all, I just want to make sure I echo what Bill and Brian said here about the importance of crypto to the world. It's huge, and definitely its benefits to the society overcomes like a lot any of its energy consumption. And I do believe that in the long term, like crypto can actually be a driver for a more sustainable energy consumption worldwide, like more like green energy, and for everything that everyone here in the panel said. And what I feel that we are doing here is like we're anticipating that move, like offering a product that offsets right now the energy consumptions and the carbon footprints of the bitcoins of our funds. And this is like our BIT11. This is our Bitcoin only ETF. And Bitcoin's a proof of work right now. It still consumes a lot of energy. And although we believe like things are going to change for good, right now we're kind of like anticipating this change. And the way it works is actually we partnered with like the Crypto Carbon Rating Institute in Germany, and they do an estimation of like the Bitcoin network overall energy consumption and carbon emissions, a lot relying on peer-reviewed methodology, third-party data like Cambridge Bitcoin Electricity Consumption Index, and a couple other sources. And the way it works, it calculates like the share that our bitcoins have in the overall emissions. So usually in the end of a year period, they provide us a report of our carbon footprint, and we buy this carbon credits usually in projects in Amazonia and Brazil, and some projects worldwide.
Okay. That's yeah. I mean, is there any particular criteria when you choose which credits to buy? I think you mentioned Amazon. Is that because it's you guys are based in Brazil, so you focus on more local?
Yeah, we're based in Brazil, so there are a lot of interesting projects here right now, and we're supporting like a big organization here in Brazil that is audited and pretty serious. It's part of like a global organization, but we're starting local here, and like hopefully to spread. But Amazon is like a very important force for the world, right? So we want to make sure it's safe.
Okay. So Brian, I'm now going to turn to you. You already mentioned proof of stake, which consumes lesser energy. So this is only one consensus protocol. Are there any other greener blockchains, crypto that you're looking at? And also maybe you can share with us a little bit more about why we should be excited about ETH 2.0.
So I think actually what would be helpful, hopefully for people here, is to go back and understand why proof of work exists. And if we kind of rewind time a little bit, we can understand, hopefully I can shed some light on why you can't strip Bitcoin or a native token to one of these networks when dealing with consensus. And hopefully this will crystallize for some people like, that's what this is all about. And so my example here, I promise this won't be super long-winded, but if we wanted to, let's say, maintain a database, version 1 of this would be Melody says, I have a database, everyone just submit their transactions to me and you'll record them. The problem with that is, you've got this proclivity to printing a bunch of money and giving it to yourself. And so Roberta, Bill, myself, we all go, that didn't work that well. So we update it and say, why don't we all take turns maintaining the database? And everyone goes, well, that sounds like a fair idea. And we set out some rules. And the rules here we say are, we are going to take turns in a round robin updating the database, and we're going to vote on the updated state. And the ledger that has the most cumulative votes, we agree is the correct ledger. Okay, fine, sounds good. So we go around and all of a sudden it gets back to Melody, and Melody, damn it, she likes printing that money again. And so what happens is we don't all vote on your updated state. They continue to vote for my page of the ledger. Now you have a fork in this blockchain, and there's no problems here, right? We all know each other and we can kind of keep each other in check. Now the question that Satoshi Nakamoto solved in Bitcoin was, how do we let an unknown participant participate in this validation, right? They live somewhere else in the world. Maybe they live in a state next to you. How do we let them participate? We go, well, shouldn't be a problem. We're just going to vote. And whether we know that person or we don't know that person, no problem, because we're going to vote. And if we don't like the changes, we just won't vote on that updated state. And what he realized is the problem is you have something called a Sybil attack. And that means that when we revealed that there were 5 unknown participants on the network, damn it, it's Melody again. Melody has duplicated herself through, she ran multiple browsers, she had multiple computers, and she voted 5 times more than Brian, Roberta, and Bill. And so what the genius of that white paper really solved was to say, it shouldn't be one person, one vote. What happened was they realized it's actually one CPU cycle, one vote. And that if Melody wants to validate more and participate on this network more, she has to give something up. And the something up is a commodity that is external to the network, which is electricity and computing hardware. And that is what's called proof of work. So hopefully people now understand that that is what this is all about, is you're giving something up. You're proving mathematically to a network that you've spent a real world resource in exchange for validation, and you are rewarded with a native token to that network. And that token cannot be a US dollar. It can't be any other currency. It has to be something native to that network, because if you want people from around the world to participate in validation, they can't be susceptible to the monetary policy of any one nation, or whatever that token was supposed to be. It has to be something native to the protocol. And so that's kind of the genesis of proof of work. Proof of work technically was an idea that was around in the 90s for some email spam, but I won't get into what that is. But that's what Bitcoin mining is all about. Now, there's a problem in proof of work. There's a few things that I think are a little funny about how it operates. But one thing is, the ethos of these networks is decentralization and maximum participation. And the problem is that over time, people created computer chips that would outpace a home laptop. And so mining ended up getting centralized into parts of the world that had access to free or near free electricity, and access to the computing chips. I live in Toronto and I pay 12.5 cents a kilowatt hour, something like that. And so there's no way I can validate one of these networks against someone who's paying 2 cents a kilowatt hour or 3 cents a kilowatt hour. It's just not going to happen. And so you've seen this concentration on the validation side to parts of the world. So they live in cold parts of the world. El Salvador's got their volcanoes that they're very excited about now. That's good for them, but bad for me. Now remember that these networks are all about maximum participation in terms of how they are governed, how the blocks are created, the transactions, and put into pages of the ledger. And so this idea emerged from Ethereum in the very early days called proof of stake. And the idea here is that if you have a smart contract platform where you are able to program the protocol in a bit more of a sophisticated way than Bitcoin will allow, you can actually let users lock up their native token, as I was saying, into a bond with the protocol. And then we can go in a round robin like fashion and take turns creating blocks. And instead of putting electricity and computing hardware at stake, now we're putting the native token of the network. And what I really like about this is that it aligns the actual users of the network, the token holders, with the validators. And in proof of work, you don't necessarily have that. You can have someone who's basically, performing a picks and shovels like business where they're validating the network, but they don't necessarily care about the Bitcoin. In proof of stake, the token holders become the validators. And it moves a little bit closer back to that ethos of maximum participation. People around the world who live in places like Toronto at 12.5 cents a kilowatt hour, I can participate in validating the network, and we've abstracted away the need for the electricity. Now, people are going to test different forms of consensus protocols, proof of stake just being one of them. There's something called proof of authority. I won't get into technically what these other things are, but Ethereum 2.0 basically transitions Ethereum from a proof of work blockchain to a proof of stake network, which allows more participation in terms of validation. Now, this doesn't come without other issues. There's still the risk of concentration. Large Ethereum holders are able to validate more than someone else, but it does move the needle, in my view, closer towards what blockchains were supposed to be. And the fact that people can participate regardless where they are in the world, get rid of the energy issue, get rid of the need for computing chips. And we already have a chip manufacturer shortage right now. I ordered a new car. We'll see if it even gets delivered when they said it would. Proof of stake is something that's really exciting. The transition, though, in Ethereum is very hard. I won't go too into detail why, but basically you can imagine Ethereum as an airplane that's mid-flight, that's a $400 billion market cap, settling literally trillions of dollars on this ecosystem inside of this platform. And they're trying to create an adjacent airplane that is much more efficient, that is much more democratic, and to transition all of these assets, all of these smart contracts, all of the things that exist here over here, kind of mid-flight, is very, very hard. So there are other proof of stake networks, Solana, Polkadot, Near Protocol, Avalanche, there's tons of them out there. None of them started as proof of work and had to go through this transition. And so when people say Ethereum's not scaling fast enough, and for people who don't really know what scalability is, it's more about, getting throughput, transaction fees down, allowing more activity to take place on these networks. Ethereum is trying to do this while they've got this $400 billion experiment, already going with a lot of existing infrastructure. And you can imagine that the developers, despite all of the institutional financial crowd who wants it to happen tomorrow, they have to do it when they know that it will work and when nothing, will blow up. So it's a transition that began in December of last year. It's called the Beacon Chain. The first version of ETH 2.0, the first phase, which is called phase 0, is now live. And over the next, 6 months to a couple years, we will see Ethereum 2.0, the proof of stake version of Ethereum, come to fruition. It's going to be bumpy. There's going to be hiccups, but it's a really exciting time, I think, for institutional investors to look at the space and to say, Bitcoin is a really exciting asset. It gives this, hedge against inflation. It's basically the birth of an entirely new asset class. But if you scratch the surface a little bit deeper, you go, well, there's this whole other rich ecosystem out there, and Ethereum is really at the heart of it. Of course, I run Ether Capital, so I'm going to be talking about Ethereum, but I am looking at other smart contract platforms. I'm following the research and the teams and what's happening there, and this is all very good. It's all very exciting. And so I'm obviously very bullish on proof of stake and the opportunity in a global environment where interest rates are zero, that people can generate a 4 to 6 or 7% yield by owning these native tokens that they're long on anyway, right? If people have low time preference, 6 months, 5 years, whatever it is, they want exposure to these new commodities. And what proof of stake does is it takes these unproductive commodities and turning them into a yield generating instrument. And that is something that I think is really, really going to be exciting for institutional investors, retail investors. That's why I wake up every day. That was a little long-winded, sorry, but hopefully everyone now understands kind of what's going on in the space now, and what's going on with validation and these consensus mechanisms, and why you can't just strip the tokens out of the network. When people say things like blockchain, not Bitcoin, I go, but you can't do what Bitcoin does without a token in that protocol. Right? The whole point was unknown parties to be able to come to consensus on the state of a ledger without having to know or trust one another.
Thanks for that. I agree. The crypto asset class is so much larger than just Bitcoin. And the ESG debate has been largely focused on Bitcoin mining, energy consumption, but there's so many other resources and other tokens out there that can drive ESG and are more ESG-aware. So, final thoughts. I want to ask each panelist to share one idea or opportunity that they're most excited about now, and how that idea or opportunity will transform in the next 6 to 12 months. So why don't we start with Bill first?
Yeah, sure. And just before I comment, as I mentioned, I'm coming from an environmental finance side. I'm not a blockchain expert. I'm becoming one, I guess, but I love the creativity in this space. So seeing things like proof of space and all these different protocols, it's just really encouraging to see people recognize issues, they solve issues. It's fantastic. I guess what I'm excited about is that, the world's come together, and I guess appreciated that climate change, dealing with climate change is absolutely critical. That sets the stage for a need for, trillions in climate aligned finance. And the role that blockchain is playing, starting to play, and will play in this market. In the coming months, we'll see, some billions of dollars transacted where blockchain's playing a role in either verification or tokenization of those assets, or both, allowing a wider audience of investors to participate in climate finance, really high quality risk adjusted returns available for more people. I guess I'm excited to see that over the next 24 months become trillions of dollars of climate aligned finance, where blockchain's playing a real meaningful role in allowing that to happen or accelerating that.
Great. Roberta, what about you?
Yeah, I think my thoughts would be the more I study crypto and I get involved with blockchain, more excited I am about the power of this technology to really advance the world in a very good way. And one thing that really strikes me is that we become biased because we are surrounded by crypto people when we study crypto, and we believe that people crypto is there, and the reality is they're most of the world is not even aware about this. So what I think is that what I've been seeing is that I think the next few years we're going to see a lot of capital invested, VC capital investments, invested in the blockchain ecosystem, and this capital is going to help us to scale thousands of different projects that can be very powerful and are going to help us to reach the next level of people. So I'm pretty excited about the next few years in the crypto space, and I think we're going to be able to touch many more lives and have many more investors and bring more people to our chain. That's what I feel.
Brian, you have the last word.
Last word. So, I'm excited to actually move beyond what are called layer one protocols, Bitcoin, Ether, Solana, Polkadot. That was stuff I was excited about a few years ago. Now I think it's time for builders to focus on the application layer. So you have the consensus mechanism down here, and now it's time to start building things. There's the design space is so wide in crypto, where we need to solve problems on chain. We need to have on-chain governance, on-chain insurance products to ensure smart contracts from failure. There's so much that's happening. Loans and decentralized stablecoins, things like Maker and Dai. You're seeing the NFT marketplace explode, and most of it probably will disappear. But there's going to be some gem products that stick around. Fractionalized ownership of NFTs is something I think that you're going to see soon. And then things like DAOs, decentralized autonomous organizations, ways to form capital and maneuver that capital where they don't have corporate structures like what we're used to. And then the metaverse, which is still kind of a crazy idea for me to imagine why I'm going to go to a virtual art show, but dressed as my crypto punk. I'm kind of getting it, but I think that stuff is going to get more exciting, and it's going to become more normalized. And when people say to me things like NFTs have no value and this is, it doesn't make any sense, I go, well, you said all the same things about Bitcoin in 2013. And they go, well, that was different. I'm like, was it though? So I think just as everyone on the panel was saying, is that the space is becoming normalized. More people and capital and mind share is moving into this space in all different areas. And that's really exciting to see. And so I think it's going to be a really exciting few years ahead, despite some bumpiness in the form of regulation globally. I think people are now realizing this bull run that started kind of mid-2020, different than the bull run in 2017, driven by the ICO mania, is a group of new investors who have come to the table and recognized the asset class, recognized the concept of algorithmic or software-based monetary policy as something that's here to stay. And now it's time to figure out how can we contribute and make this ecosystem even better than anyone imagined.
Great. Thank you so much to all the panelists for sharing their insights and your ideas. Now, unfortunately, time is up. But thanks again. And so next session, we'll have the manager elevator pitch. So over to the MC.
Thanks, Mel.
Thank you.